Did you know that while everyone's been debating whether the UK property market will crash, it's actually been happening in slow motion for the past 18 months, and the data that proves it has been hiding in plain sight? I'm about to show you the real numbers that property experts don't want you to see, and why this could be the biggest wealth transfer opportunity of the next decade. What I'm about to reveal will completely change how you view the UK housing market. We're not just talking about a simple correction here. The data I've uncovered suggests we're witnessing the early stages of a fundamental restructuring that could reshape property ownership across Britain for generations. Let's start with something that should terrify every property investor in the country. While house prices have only officially dropped by 3%, according to mainstream reports, the real picture is far more dramatic when you dig into the data that matters. Regional variations are telling a story that national averages completely miss. Take Greater London, for example. Yes, the headline figure shows modest declines, but when you strip away the luxury penthouses in Mayfair, skewing the numbers upward, middle-class areas are seeing drops of 15 to 20% in actual transaction values. I'm talking about places like Croydon, Barnet, and outer zones where normal families live. The properties that sold for $500,000 in early 2022 are now struggling to find buyers at $400,000. But here's where it gets really interesting. The crash isn't showing up in official statistics because of something called phantom inventory. Estate agents are keeping properties listed at unrealistic prices rather than accepting market reality. This creates an illusion of price stability while actual transactions plummet. In some London boroughs, property sales have dropped by over 40% compared to pre-pandemic levels. But because unsold properties stay listed at inflated prices, the average looks stable. Now let's talk about mortgage approvals, because this is where the house of cards really starts to tumble. Bank of England data shows mortgage approvals have fallen to levels not seen since the 2008 financial crisis. But what's truly shocking is the demographic breakdown of who's getting rejected. It's not just people with poor credit scores anymore. Middle-class professionals earning £60,000 annually are being turned away for mortgages that would have been rubber-stamped just 2 years ago. The lending criteria have become so strict that banks are now stress testing potential borrowers against interest rates of 8% or higher. Think about that for a moment. They're essentially preparing for a scenario where mortgage rates double from current levels. Why would they do this unless they knew something we don't? Here's another piece of data that's been flying under the radar. Buy-to-let mortgage applications have collapsed by over 60% year on year. Property investors, the people who drove much of the price appreciation over the past decade, are completely absent from the market. They're not just being cautious, they're actively selling. Rental property listings in major cities have increased by 30%, creating a supply glut that's driving rental yields down just as mortgage costs are skyrocketing. The ripple effects are already visible in regional markets that most people ignore. Take the northeast of England. Properties there are sitting on the market for an average of 6 months compared to 6 weeks in 2021. Sellers are having to reduce asking prices multiple times, and even then, many are withdrawing from the market entirely rather than accept the new reality. But perhaps the most telling indicator is something called the Mortgage Distress Index. This measures the percentage of homeowners who are spending more than 50% of their income on mortgage payments. In certain postcodes across Manchester, Birmingham, and Leeds, this figure has jumped from 12% to over 30% in just 18 months. These are people who bought at peak prices with low rates and are now facing financial ruin as their mortgages reset. The construction industry data tells an equally alarming story. Planning applications for new residential developments have fallen off a cliff. We're talking about a 70% reduction in major projects getting approved or started. Builders know what's coming, and they're not willing to risk getting caught with unsold inventory in a falling market. This means the housing shortage everyone talks about isn't getting any better, but it also means builders expect demand to crater in the near term. Let's examine the commercial property sector, because it's often a leading indicator for residential markets. Office buildings in central London are trading at 30 to 40% below their 2019 values. Retail property is even worse. Shopping centres and high street shops are being sold for less than the cost of construction in many cases. When commercial property collapses like this, residential usually follows within 12 to 18 months. The really scary part is what's happening with new builds. Major developers are offering incentives that essentially amount to massive discounts disguised as buyer perks. Free stamp duty, furniture packages worth £50,000, even cars thrown in with property purchases. These aren't marketing gimmicks, they're desperate attempts to move inventory before the market recognizes the true values. Regional banks are starting to tighten lending even further. Some are requiring deposits of 30 to 40% for new mortgages, effectively pricing out entire generations of potential buyers. The days of 5% deposits and 100% mortgages are not just over. They're looking increasingly reckless in hindsight. Here's something that should concern everyone, not just property owners. Local government finances are heavily dependent on property-related taxes. Council tax, stamp duty, and development fees form huge portions of municipal budgets. As property values decline and transactions dry up, local authorities are facing budget shortfalls that will impact public services. This creates a feedback loop where declining areas become less desirable, further depressing property values. The international data provides additional context that's deeply troubling. Similar property bubbles are deflating simultaneously across Canada, Australia, and New Zealand. These markets often move in sync with the UK due to similar monetary policies and foreign investment patterns. The fact that all these bubbles are deflating together suggests this isn't a local phenomenon, but part of a global deleveraging cycle. Foreign investment data reveals another crucial trend. Chinese and Middle Eastern buyers, who propped up luxury markets in London and other major cities for years, have essentially disappeared. Capital controls, geopolitical tensions, and domestic economic problems in their home countries mean this source of demand may not return for years, if ever. The generational wealth impact of this crash cannot be overstated. Millennials, who bought properties in the last 3 years using help-to-buy schemes and parental assistance, are facing negative equity on a massive scale. Unlike previous property cycles, this generation doesn't have decades to wait for recovery. Many are already struggling with cost of living pressures and may be forced to sell at substantial losses. But here's what makes this crash different from 2008. Back then, it was primarily a credit crisis that affected property prices. This time, it's a fundamental affordability crisis combined with demographic shifts, changing work patterns, and a generation that may never be able to afford home ownership at current price levels. The rental market is experiencing parallel distress. Build-to-rent developments that were supposed to provide stable rental income are struggling to find tenants at projected rents. Many young professionals are moving back with parents or sharing accommodation to reduce costs, decreasing demand for rental properties just as supply increases from distressed landlords. So what does this all mean for you? If you're thinking of buying, waiting 12 to 18 months could save you hundreds of thousands of pounds. If you're already a property owner, now might be the time to seriously consider your options before equity erodes further. And if you're an investor, the opportunities that emerge from this crash could set you up for generational wealth, but only if you understand the real data behind what's happening. The UK property market as we know it is fundamentally broken. The question isn't whether it will crash, it's whether you'll be prepared for what comes next. The data is clear, the trends are accelerating, and the implications extend far beyond property prices into the very fabric of British economic life.